To talk about the global macro environment as well as the investment climate, I'm joined by a very special guest. Howard Marks is co-chairman of Oaktree Capital, and he joins me right here for an exclusive chat. Howard, it's great to have you on the show. Thank you very much for your time.
It's a pleasure to be here, Tandra.
Yesterday, the Fed gave the markets what they wanted, which is essentially a 25 basis points rate cut. Now, typically, the market perceives a rate cut to be a buy signal, but yesterday's market reaction was rather muted. What does that suggest?
Well, number one, if events are anticipated, then maybe the rise takes place on the anticipation, not the event. Number two, there's a difference of opinion about whether a rate cut at this point in the cycle is a good thing or a bad thing. So I don't think that it's automatic that rate cut market goes up.
But to your mind, is this rate cut a good thing or a bad thing? And does this rate cut have any effectiveness in the economic cycle as things stand right now? What do the last two rate cuts, the one in the previous policy plus yesterday, mean for the economy?
The question is, what is the Fed trying to accomplish? What should it try to accomplish? You know, for 100 years, it's been the job of central banks to control inflation. Then 30, 40 years ago, they got a new job, which was to support growth of the economy so that jobs would be created. But this idea of preventing the next recession is neither of those two things. And it is a job that the Fed seems to have taken on now. And in his talk 6 weeks ago, Jay Powell talked about continuing the expansion. That's not necessarily the Fed's job. I put out a memo on the subject, as you know, about a month ago, called On the Other Hand. And I put it out on a Friday, and that Sunday I happened to visit a friend who had a guest, a Fed president. And he said that there's a difference of opinion at the Fed as to whether they should be cutting at this point in time, and that he didn't think so, and he belongs to a group which thinks that it's the job of the Fed to create growth over time. And the idea of creating growth over time and jobs over time sounds like a very good one to me, as opposed to creating growth and jobs every year.
But do you think the Fed needs to be proactive? And had it not been for President Trump and his tweets, plus the big fall in the markets last December, do you believe the Fed would have cut rates? Would they have given the markets these rate cuts?
Well, I don't know. A lot of people think that President Trump's influence on Chairman Powell contributed to the rate cut. It may have been or not. Powell trumpets his independence. But certainly Trump was beating on him to cut rates, and he did. And that raises a very interesting question. Should the Fed cut rates to stop the stock market from going down, which is different from the recession? Okay, so you want to create jobs. Okay, maybe you want to prevent recessions, which I don't think you can do in perpetuity, but do you want to cut rates because the stock market's going down? I think that's totally illegitimate.
Because this rate cut seems more like something that's addressing the sentiment,
yes,
the need of the
yes,
hour, rather than it having anything to do directly with protecting the economy.
Right. So you may say pandering to investors. I think that's right.
And that's not really the Fed's job.
That's not the Fed's job. And by the way, our economy is doing pretty well. And normally you would cut rates, as we did 10 years ago, to get an economy going. It's stalled, global financial crisis, lots of declines. You want to cut rates to get it going. Okay, that's fine. 10 years later, do you want to cut rates to extend an economic expansion which is the longest in history? Again, I question whether that's a legitimate goal.
Do you also question the strength of the U.S. economy and whether we are heading towards a recession? That's the big question. That's the question that the market's been obsessing over.
Well, number one, Tanver, people say to me, are we heading to a recession? We're always heading to a recession. The question is, this year, next year, or 5 years from now.
And after 11 years,
exactly,
that question is a very pertinent one.
Exactly. But, you know, our economy, I called that memo on the other hand because, you know, we have different considerations. Our economy is doing pretty well. There are sources of strength, mostly our consumer. There are pockets of weakness, manufacturing. Manufacturing is having a lot of trouble being optimistic right now, given the trade war. Our economy is the best performing in the world of the major economies. I'm happy with it. I don't think I'd be stimulating it at this point in time.
So the economy doesn't need rate cuts?
I don't think it does. Well, again, if your goal is to make sure we don't have a recession this year, next year, the year after that, maybe you want to cut rates, but I question that goal.
So then what about some of the Fed members, board members essentially saying, what 25? We need 50. James Bullard.
Well, I think maybe only one, other than the president. Yeah. Look, in every endeavor, there are pros and cons, strong and weak. We have, in the Fed, we have hawks and doves. So, you know, there are some people who think it's extremely important to prevent a recession, and some people who think that recessions are naturally occurring, and the ebb and flow of these things is inescapable. One of the problems, of course, is that we've cut now 50, and if somebody militates for another 50 and gets it, and then a 50 after that, then we're down to 0.75%.
Pretty much nothing.
And if we have a recession, what do you do about it? You know, normally we cut rates to pull out of them. You want to have some room. I would hope that was one of the reasons for Yellen's program of rate increases, and that I believe it's a reason why we should not cut aggressively right now.
Why does the market fear a recession so much? Because as you pointed out, a recession is inevitable. It happens in every economic cycle. This is the 11th year running for economic expansion. What does it tell you about market psychology?
Well, one thing it says is that markets are short-term oriented. Everybody's become very short-term oriented in the markets, and they want the market to go up every day. And I don't think that's very realistic. What they should want is a healthy environment in which the market can go up over time.
And if that's the premise, then do you believe that so far easy monetary policy has already fueled the markets and skipped a few mini recessions to actually set the stage for a really big one hitting us, where monetary policy tools will be rendered not helping, useless essentially?
I mean, I'm not a forecaster, so I can't tell you what's going to happen, and I can't tell you what would have happened.
But that's one of the things you've raised in your memo.
Well, and I think that maybe we would have had some slowness by now if they hadn't stimulated. But I think I would guess probably not, because of course the stimulus is a recent thing, and the economy was doing reasonably well without it. Sluggish, certainly. I say of this economy, it's not fulfilling anybody's fondest dreams, but it's doing okay.
In your memos as well, I think it was this time it's different. You spoke about the inversion of the yield curve and how, again, investors panicked when that inversion hit us, right? You're not a big fan of that as a warning sign. What would be the red flag for you to essentially signal that things could be slowing down and that a recession will be around the corner?
I'm not that excited about the yield curve inversion. The mere fact that the short rate is higher than the long rate, because nobody can explain to me its influence. You know, they can say that most recessions have been preceded by an inversion. By the way, that's different from saying that most inversions have preceded a recession. Yeah. But until somebody can explain to me why it should be influential, then I'm not going to get too excited about it. You know, I think the key is job creation, and you know, job creation is well, we had a weak month, but it's still positive, and you know, I think that's the red flag.
What is the bigger risk for the U.S. economy? Because you believe the economy is holding up, the numbers are looking supportive, and a large part of the strength is coming in from the U.S. consumer. So do you think externalities, the U.S.-China trade war, is the big worry, and that's why policymakers want to, you know, err on the side of caution and do whatever it takes to kind of protect the economy from that side, from that downside?
Maybe so, but can you? You know, and I think that since the consumer is so important, I think the question is it possible to get an external shock which takes the optimism out of the consumer? You know, is there a limit to how much debt they'll put on to accelerate spending from the future to the present? I think that's really the question.
You wrote something that really jumped out at me in one of your memos, where you highlighted that in recent years, experienced growth, low inflation, expanding deficits and debt, low interest rates, and rising financial markets are all, which are incompatible indicators, are all working together.
Yes.
Which one of these variables stands out to your mind? And which one are you most mindful of at this point?
I think the low interest rates are the outstanding characteristic of today's financial environment, and have been for close to 10 years. And, you know, as you say, the strong economy and the low interest rates are something we usually don't see. If we should happen to get inflation above today's level, then you would think rates would go up. And you would think that higher rates could have a cooling effect on this economy.
I'm sure you've been asked this question a zillion times, Howard, about when do you see the recession hitting the U.S. economy? You know, Ray Dalio was here a few weeks ago, and he put a chance of 40%, essentially a 40% chance of there being a recession in the U.S. before the presidential elections next year. What would your chance be? Is there a chance that you're putting out there?
Well, I start every conversation by saying that I'm not a forecaster. Ray is. You know, Ray has built his business on macro forecasts, really, and understanding the macro. You know, it doesn't feel to me like a recession is imminent. I don't think we're going to go 5 years without it. So sometime 2 years from now, something like that. But as I say, I don't put numbers on it.
You don't, I know.
Yes.
And because we've had this conversation in the past as well. We're in the 9th innings. This is a late cycle, but the late part of the late cycle has also extended itself out.
Yes.
Right?
Yes.
So where are we on a timeline?
Why do we say we're in the 9th inning? Because there had never been an expansion that went more than 10 years. So when you get to 9 years and 9 months, you tend to say, well, I think we must be near the end. But now we're past 10 years, and it hasn't punked out yet. And, you know, there's no rule which says we have to have a recession after 10 years. And even who was it? Templeton. I quote him in the memo. This time it's different, and he said even he says 20% of the time it is different. So we tend to say recession in part because of how long we've gone without one, but you know that doesn't mean there has to be one.
Okay, I want to touch upon the geopolitical risks which are on the market's mind right now. The big disruption in the oil market, and the markets have settled down. They've calmed down after what happened over the weekend. Is there still more risk left in the situation, and do you believe that things will perhaps de-escalate from here, or is there a major risk? Is there a major concern on how things will unfold? In the Middle East especially.
Yeah, well, look, the Middle East is a mess. The fact that one raid can do so much damage and upend the status quo so much shows you how exposed we are. I've been talking about geopolitical risks for a long time. Until this week, none of them really came to fruition. I mean, the trade war, on again, off again, threat, not threat, but it never broke out into open hostilities, as happened in Saudi Arabia this week. And is what happened in Saudi Arabia the end of the line? There's no reason to think so. I mean, if the people who did that want to do it again, it can happen again.
Does that open more upside risk for oil?
If I don't watch the Fed, I certainly don't predict the price of oil. But in the short run, yes, I would think that, but it's very hard to say what price for oil is consistent with what environment. Is the price today right for today's supply-demand environment, or too high or too low? It's hard to say. It's hard to say where we're going.
Okay, just last couple of questions, Howard. You're taking interest in the Chinese distressed debt market.
Yes.
What do you like about that space in the region?
Well, I mean, there is a lot of distressed debt, and there's not much supply in the world. We've been working there for 4 years, gaining experience with it, and the experience has been positive. We're working with Chinese partners. We believe that we can rely on the rule of law. We believe that the authorities in China understand the importance of having a functioning distressed debt market in order to permit the banks to recycle their otherwise moribund capital. So, I mean, I think that things are moving in the right direction, and it's an activity that we would rather be in the vanguard of than play catch up in future years.
What about the slowdown risk in China? 6%. Premier Li Keqiang earlier this week said, not happening. May be a challenge.
Yes.
China feeds a large part of Asia. Is that a big risk, or your view is 14 trillion, 6%, 5.5%, 5%, not that bad?
I think that one of these days they'll have a slowdown. They've gone 20 years without a recession, and their growth rate has been among the highest in the world. It's not going to go on forever. They have had an unusual spurt of growth with people moving from the farms to the cities, industrialization, strong exports, cheap labor, heavy availability of capital for capital investment. Some would say excessive capital investment. One of these days, those factors will stop being sufficient. One of these days, they'll have a recession. But again, what did we say 10 minutes ago? It's a natural thing.
China recession or China slowdown?
Okay.
Yeah. China recession or China slowdown?
What's the difference?
Okay, yeah, fine. I want to talk about your investment philosophy right now in this market. I don't want to get into specifics, but you spoke about sanity in stocks. You spoke about emerging markets being underpriced. What would be your top value call right now? I mean, there's been a view on gold. I don't know whether it's a value proposition or not, but it's done really well this year.
Gold can't be a value proposition. It's impossible to put an intrinsic value on gold, and that is the definition of value investing. Obviously, gold did nothing for many years.
5 years plus.
Well, more than 5. It ran from a low price, triple digits in the crisis, up to 1950. Yep. Then it backed off to 1350, and it stayed around 1350 for, I don't remember the numbers, I would say 8 years. Yeah. And then this year, a few people got together and they say, hey, wait a minute, maybe gold is what we should resort to given the geopolitical uncertainties. The price of any asset is an indication of its popularity. So I think that gold had a spurt in popularity this year, and people, some opinion coalesced around the idea that gold is good in times of uncertainty.
So then where's the value according to Harvard Marks?
Well, you can't compute the value of an ounce of gold.
Not in gold.
Where is value? Well, look, we do like the emerging markets. mainly because most people don't. And in the investing business, you find better bargains among the things that are unpopular than popular. And you know, most of our strategies, credit, real estate, and so forth, I think most things can be invested in reasonably these days as long as you're careful. You know, our motto has been move forward but with caution, and I think the caution part is a very important part of the equation.